This is the most recognised house price forecaster in New Zealand, and he's about to share his top property predictions for 2026. And that really matters because half of New Zealand's wealth is tied up in property. So if house prices go up, there's a good chance you'll get a lot richer. But if they fall, you could find yourself losing tens of thousands of dollars. So in this episode of the Property Academy podcast, we'll start by finding out what Tony thinks will happen to house prices in 2026. And once we find out how much Labour's capital gains tax could throw a spanner in the works, then you'll finally know how much money you could potentially make or lose over the next 12 months.
And today we are asking Tony Alexander to look into his crystal ball and think about, well, what is going to happen for New Zealand housing over the next 1, 2, 3, 4, potentially even 5 years. So let's start with the big picture view, Tony. What's going to happen to house prices and the housing market over the next 5 years?
Rightio, there's a comment I've been making for a number of years now that ever since about 1992, when interest rates fell down and then a lot of people moved into investment property or property as an investment asset, house prices on average around the country, so the whole country, have increased about 6.7% a year. That is not what we're going to go at for the next 5 to 50 years. We won't have, the 30 years of interest rates falling, which was a key characteristic back then. We won't have sort of a structural lift in net migration into the country as well. These are things which have already happened. So I'd suggest the average going forward is going to be something around about 5 to maybe 5.5%, reflecting in general inflation, increases in wages, ever increasing construction costs out there of the materials, the labour, etc. And just the fact that more people, but there's only so much land and there's not always a willingness to have new subdivisions all over the place. So if we're looking out 5 years, it starts to fall into that longer term category. I'd expect an average increase of 5 to 5.5%, and same for 10 years, 50 years.
And is that a nationwide number? And how does different regions or different parts of New Zealand do compared to others, do you think?
Yeah, that's an interesting question because everyone listening to this is now going to be thinking, oh, I know what he's going to say. Auckland is going to outperform because it gets the migrants, for instance. Christchurch, Canterbury is going to outperform because it's still got post-earthquake catch-up. It's got post-pandemic catch-up, etc., and the tourism sector to come along. Fantastic rural hinterland, etc. Other areas, I don't know about the west coast of the South Island or anywhere like that. But every now and then in my publication, I'll publish a list showing the average increase in prices for a region since 1992. And if you ignore Queenstown, wealthy people, limited availability of land, etc., the difference from one region to another is not as large as people may think. And why is that? Because in regions where there's strong demand, there tends to be a strong construction supply response. And that's one of the key differences now going forward. We can talk about later, more supply of houses on average coming forward. But if I really had to say, what do I think will be different? I'm still very positive on Christchurch. For a variety of reasons. And you've had Aucklanders, young, old, shifting down there for a while now, and I expect that to be continuing as well. Good capacity with people retiring out of Auckland to be going to your likes of your Tauranga, your Hamilton, up to Whangarei, Kerikeri, etc. as well. But I shouldn't also ignore one area which we've talked about for decades, and people go, huh? The likes of Invercargill, of Southland. And that's what I point out to people. They don't necessarily build as many houses as the rest of the country. So if they don't have the same population growth, it doesn't necessarily matter. You get a good yield in a lot of these places. So there's just some thoughts.
And Tony, one of the things I always find interesting is, okay, over the long term, let's say everywhere does perform at pretty similar rates, but often investors are thinking, okay, where am I going to see some decent growth over the medium term, so over the next 5 years, so that then it makes me feel encouraged to repeat that process. What would be your picks based on areas in terms of where they're at in their cycle to get a good deal right now?
Yes, okay. I mean, my usual answer to that is look at where the infrastructure is going. Look at where the extra people are going. Look at where the motorway is being extended, for instance. And of course, that falls into the lower part of the North Island there. I don't expect outperformance by Wellington City. It's not just the earthquake problem down there, for instance, and the fact the weather's horrible, but the expressway development is up north. Otaki, you can get just beyond that now, and eventually Otaki to north of Levin, and maybe eventually to Palmerston North. And so for the next 50 years, there's so much of economic and development will be up there, and so housing development, etc. So maybe that suggests buying and holding on to some land is something. Good luck, because a lot of people have already been over that one now for 10 or 15 years in that regard. But also, of course, Christchurch, you look on the outskirts, the development of the Southern Motorway, the Northern Corridor, further work going to be done there. You look north of Auckland, an area I've tended not to talk much about. I've often talked about Auckland, Hamilton, 120 kilometres, gets filled in the next century in various degrees. But the bit going north, a lot of investment in the motorway happening there. And of course, that opens up a lot of opportunities for development. If I were a developer, I'd be looking at, acquiring land and creating some decent, cohesive subdivisions in those areas. I'm always dubious of when the investors later in the cycle are going, oh, it's expensive in the cities. Let's look in the countryside. And they flock to Carberra and these sort of places. And I think there can be some big cycles. And what are you going to do when the mill closes, or these sort of things? And of course, we're seeing, unfortunately, that roll through a number of locations. So seen it before. We'll see it every cycle out there. I've been surprised at the absence of much of an upturn in the broad Nelson, Tasman, Marlborough area. I would have thought a lot more people would have been retiring up there. So I'll express some slight confusion about that top of the South Island situation. So there's just some thoughts. And Auckland, much as there's going to be strong population growth over the long term up there, with the unitary plan effectiveness from 2016 and other rule changes, there's also a lot of supply coming forward of townhouses, etc.
Now, I read an article you wrote for One Roof saying that you thought that for 2026, that's probably the year to bet on the housing market starting to recover. What were you talking about there, and what makes you think that way?
Oh, okay. In terms of, housing market rising, a combination of a number of things. Number one, just a general economic upturn. When you look at the fundamentals driving the economy, you've got the interest rates coming down and staying down. The Reserve Bank's going to keep them lowish for a while and then increase sharply late 27 or 2028. But 2026 will look pretty good in terms of financing costs. The lagged impact on economy overall of the rise in farm incomes, whether it's red meat or dairy, horticulture as well, that feeds through the economy. Increased number of foreign students coming through, a lot of business investment, and all of this feeding through into better feelings of job confidence. That will be important for the owner-occupier market. I fully expect the first home buyers to remain very active in the market, as they have been since early 2023. And a few more investors are going to step forward, I think, once they see momentum. Like, you could say that about any asset market. And that will, I think, get things rolling again. But yeah, I'm very much talking about the impact of the interest rates falling away, staying low for a while, and just the general improvement in the economy and employment confidence in particular.
So there's some positive stuff on the horizon for 26, but the one thing that often kind of upsets the apple cart is the election. So how's that going to play into next year's kind of recovery?
I think the election won't have any impact on the first home buyers. So they'll continue to do what they're doing. Some of the owner-occupier market may just step back a little bit. The investors, of course, with Labor proposing capital gains tax out there, they may go, well, maybe we'll just wait and see what is going to happen here. Because what if it's the Labor government heavily dependent upon the Greens and maybe Maori Party as well? Then you may be looking at a wider capital gains tax, and then people will start talking about wealth tax as well. So I would definitely expect on the investor side some caution and stepping back in the 4, 5, 6 months leading into the general election. Some businesses, if you've got a big investment plan coming forward, you may go, let's just see exactly what happens. And that happens every election. So I think the election will have a small impact, but we have to remember the big thing running through is the fall in the interest rates and rising job confidence as well.
Now, let's say that that capital gains tax proposal does come in, it becomes a law. What happens next in New Zealand housing?
There's capital gains tax overseas, and there's still cycles. that don't necessarily seem to be any greatly different from New Zealand. So I think the main impact will be on existing investors who've been in the market for a while, have had, tax-free on paper capital gains, thinking, well, okay, we've made the bulk of the gains here. We've got a retirement to finance, and a retirement which is going to be a lot more expensive than any calculation we've ever done over the past few decades because of council rates, insurance, and all these other costs, etc. I think it will increase something I've already been seeing for over a year. A lot of those older investors, in a casual manner, looking to sell some of their investment properties or the single property that they've got, providing opportunities, of course, for first-home buyers to purchase them, or other investors who can see newer, better ways to add yield that these people who have owned it for 20 or 25 years haven't been thinking about. So that's how I think would be the clearest impact of expectation of the capital gains tax, just a bit of extra selling from the older owners.
And because interest rates play such an important role to kind of the housing market and the economy in totality, where do you kind of see rates going in the next 5 years?
Well, let's see. I reckon they'll stay lowish for the next 2 years, and then they'll start moving up through 2026 and almost all of 2027. People won't believe they're going to go up. They're not all going to abandon, fixing 1 year and suddenly jump into 5 years to beat the increase down the track. People are going to think that the rates of 2026 are going to be the new permanent steady state equilibrium and everything's sweet, because we've seen that so many times before. Again, that's why I'm confident about some momentum developing in the housing market over 2026 and 2027, leading to extra construction, more investors generally moving into the market. But I do think there is upside risk people aren't thinking about for either late 27 or 2028, 2029. Having said that, by crikey, none of us really picked the cash rate would go to 2.5 or presumably 2.25% fairly soon. So this far out, I mean, honestly, it's just about anybody's guess for 2 years and beyond.
Well, it's interesting that you mentioned that, because often when you talk about where interest rates go in the future, and not specifically you, I'm talking about economists in general, it's very easy to dismiss the 2020, 2021 2% interest rates or low 2% interest rates as, yeah, but that was because of COVID, or the 2019 interest rates, which were between 3 and 4%, about, oh yeah, but that was because of deflation worries. Or what about the very high interest rates we had just before the GFC? Oh, well, that was pre-GFC exuberance, or whatever it happened to be. Do us economists tend to forget about some of these unexpected events that can crop up and push interest rates either way?
Well, I think by definition, you can't predict the unexpected events. You just have to take them when they come along, basically into the whole mix. We have to recognize that nobody's economic models work any longer. The world and the way you and I react to changes in interest rates, exchange rates, wages, and all these sort of things is different from what it was in years past. We have got not the foggiest idea what AI is going to do, let alone AI in robots. What is that going to do? We can extrapolate that, but the actual economic impact, we haven't got the foggiest. And so really what it comes back to is something I've said, and I think other economists have said it for a great number of years. Every single monetary policy tightening or loosening cycle is a suck it and see exercise. Inflation's picking up. We need to raise interest rates. You raise them, right? I wonder what the impact will be. And you look at the data, there's no impact. Let's keep raising them. And by the time you identify an impact, that's why I say the Reserve Bank will go, oops, we should have recognized the weakness in the economy in 2024 back in February when this bloke's surveys were showing it, and not July last year when the Reserve Bank finally said, oops, maybe we're going to have to cut interest rates. Every single cycle is a suck it and see exercise. So don't believe for a second that there's high accuracy that we assign to any forecast we make for the peak in the cycle and how long it lasts, or the trough in the cycle and how long it lasts. We just take it as it comes every time around.
And one thing that you mentioned before, though, I'd really like to get some of your insight into the baby boomers, and they're entering retirement. They've got a lot of wealth, whether it be in their houses or their businesses, and there's going to be this major shift where they liquidate some of those assets to fund their retirement. Where are the opportunities for younger investors?
I think the opportunities are for those that maybe have a few simple tradie skills and have some familiarity with what can be done to a rental property to improve the yield. Because as I mentioned earlier, I think a lot of these people, they've had these investment properties for a number of years and it's worked okay. The tenants has been okay. They look after them, vice versa, this sort of thing. But it could be a bit of a gold mine with some of these places. Realize, well, actually, this doesn't need to be a 2-bedroom. This can be a 4-bedroom unit, quite frankly. And that space out the back, that's going to be easy to add a beautiful deck onto that, for instance, maybe a little bit of screening. So I think there's a few things that can be done. So I guess my advice to young investors looking at this would be become au fait with simple little, not just redecorating, but basic remodeling of a property inside and outside that can enhance the yield. And this doesn't necessarily mean building a garage or demolishing a garage, whatever, but just something around the house itself. That's, I think, the opportunity I see is coming along with some of us selling by the baby boomer, the older generation.
Yeah, and if you think about some of those, properties might have been bought for $47,000, 30 years ago, and now they're getting $600 a week rent. Like that, they haven't needed to do anything to add any value or add any have any additions so that they could get a higher yield because the market's kind of taking care of it and it doesn't really matter to them. But there will be some big opportunities in those properties where, let's face it, some of those older investors don't like spending money on maintenance, and so we take a she'll be right attitude and just carry on renting it out. But I think you're right there. And I think after going through this massive downturn that we've had, and, we didn't expect to see the market drop by, 30% in Wellington, parts of Wellington, 20% in Auckland. But, these things happen. And I know you're going to say, we probably don't know, but if we fast forward to the next big downturn, what are some of the things that could cause it?
Next big downturn will probably be an interest rate shock where the central bank has underestimated the inflation and then goes, uh-oh, we've got catch up to do. Because that's what happened in November 2022 when they increased the cash rate by 0.75%, very rare, and said, oh, we're going to put you in recession as well because inflation from 7.2% doesn't look like it's coming down in a hurry. It's probably going to be something like that rather than necessarily a big financial shock, because if it's a financial shock coming in from, well, overseas, frankly, the Reserve Bank will probably cut interest rates relatively quickly to catch the ball as it's falling. So for me, it's like 95% chance if there's going to be another big downturn down the track, it won't be the volatility and the migration along the way or just the general economy. It would simply be the interest rates having to be screwed quite high because of underestimation of inflation by the central bank. I don't expect that over this cycle. But then, as Monty Python said, you don't expect the Spanish Inquisition. These things come along.
And so basically you're telling us is going to be the same thing all over again. We're just not sure exactly how many years till we get there.
Well, yeah, some elements will be the same, but there'll always be unique characteristics. And one of the characteristics I do want to emphasize here, stepping back from just the short-term sort of stuff there, the longer-term stuff. You see, this is the job of us economists. Try and tell people where we are in the cycle, examine special factors, remind people of longer-term trends. And the longer-term trends would be, one of them, the absence of 3 decades of falling interest rates. Okay, so that's sort of been and gone. But the big change is this: more supply of dwellings coming forward. And every now and then I'll publish a graph in my weekly publication where it starts in about 1970, and it is the ratio of the number of consents issued for new dwellings to be built versus the population. So in 1974, I think it was, the number of consents was 40,000. Population was 3 million. The ratio, what's that, about 1.4%. The average ratio since 1970 to now has been 0.65%. So that's the average, 0.65. What would you expect that ratio to be after you've had really high interest rates, crunching by the Reserve Bank, falling away of the migration numbers, the economy shrinking 1.6%, the unemployment rate going from 3.2 to 5.3%? You'd be thinking, oh man, we must be well below that ratio of 0.65%. Well, if you're quick on the uptake, you'll be thinking, oh, hang on, the number of consents issued the past year is 35,000. The population is 5.4 million. Oh, hang on, that's almost 0.65. there has been a structural change in the average level of house construction in New Zealand, courtesy of intensification and freeing up of the land as well. That is a key dynamic shift for the next half a century.
And yet, despite all of that, you still think that house prices are still going to go up by 5.5%?
Well, the cost of construction, building them seems to go up all the time, quite frankly. And while councils have to make 30 years worth of land available for expected population growth, not everybody wants to live that far out. Most people still want to live reasonably close in to where they, where they work, entertainment, that sort of thing. And so you're still going to get some upward pressure, probably more so in the inner city and fringe areas. You'd have to go to a proper big city to see that in action, Sydney or Melbourne, that sort of thing. But yeah, basically, and income increases on average each year, wages rising about 3.3% per annum is sort of the starting point here. And then you add on a bit more for scarcity, construction cost increases.
And Tony, what about this with kind of that model that you're using around the ratios? So, previously, if we go back 30 years, so you're a family of 7, Ed and I are both families of 6, but nowadays people are having smaller families and maybe we require more houses for the number of people in terms of that ratio. How does that play into those numbers?
Let's see, housing for the number of people, slower population growth, but still more individual units coming along. Yeah, I can't see anything jumping out that necessarily disturbs that. In terms of family formation, previously the families were bigger, now they're smaller, but you still want your own place to live in, not sharing with some other crowd. So yeah, I don't really think it changes that dynamic all that much.
So now you know where house prices could go in 2026 and beyond. And if house prices do rise, the next question is, how could you use that trend to get financial freedom for you and your family? Which is why you need to watch this video, where I'll share my 9-step property blueprint to retire rich at 55. Click the video on your screen and I'll see you in there.